I have an active investing and a passive investing system. My passive investing system happens every Wednesday. And every time I say that, I get so many comments of people saying, well, Jaspreet, why did you pick Wednesday? As if it was this like secret sauce system of something that happens on Wednesday. It really wasn't. It was just in the middle of the week, hump day. So I picked Wednesday. And every Wednesday, money is pulled out of my checkings account and is invested into my portfolio of funds. And that happens every Wednesday. It doesn't matter if the market's up, if the market's down, if it's raining outside, if it's sunny outside, if it's hailing or thunderstorming. I do it no matter what. And I want to give you this little piece of caution here because markets go up and markets go down. And a lot of times people invest their money thinking that I'm going to make a lot of money in 6 months. And you're constantly watching your portfolio, seeing what your portfolio is doing today and tomorrow, the day after that. And it's going to give you all this anxiety. But what you got to remember is markets go up, markets go down. And if you're investing for the long term, and if you have a good asset, well, you don't need to monitor it day by day. If you go and buy a home tomorrow, you're not going to check Zillow in the afternoon and see what did the home price go to. And then next week to see what happened with the home price. I mean, that would be kind of crazy because home prices don't move like that. Stock prices move all the time because, well, you can buy and sell a stock with the push of a button. And so if you're going to be investing in stocks, understand markets go up and down. It's a fact. We've seen a recession in our economy every decade for the last century, and we're going to continue to see recessions. We're going to continue to see market crashes. Now, market crashes are scary because everybody panics, people freak out, but they also create opportunity. And they create opportunity only for those that are financially educated, prepared, and understand the trends. And what I mean by that is when market crashes happen, and we've seen, well, quite a few in the last couple of decades. We saw one in 2020, 2008, 2000, and every time we see a market crash, the same thing happens. People panic and they sell, and the financially educated come in and they buy good investments for pennies on the dollar. And so this is where you have to learn to stay calm, cut through the emotions, find the opportunity, and use them as an opportunity to invest. And this is where just understanding, look, markets go up and down. You can't time the market. You want to be able to win when the markets are up and down. That's where the wealth is built. Because, well, if I'm being completely honest with you, I made a lot of money when the 2020 crash happened. I made a lot of money after the 2008 crash happened because they created opportunities. But again, that requires you to be prepared. That means you have to be financially prepared. You have to have cash to be able to protect you, but also be able to capitalize on opportunities. I mean, if you see a great investment opportunity tomorrow, you see an amazing stock, an amazing business, amazing investment, but you have no money to buy it, it doesn't do you any good. That's where you want to start preparing. Then you need the financial education, right? You need to know, what do you invest in? How do you analyze an investment? How do you actually invest your money? That's what financial education is all about. And then you need to understand the trends, which is what industry do you want to be invested in? Like you can know what I want to invest in, but if you don't know which industries, like I want to invest in a fund, but I don't know what type of fund to invest in, I don't know what industry to invest in, well, that doesn't give you the best returns because you want to be investing your money into an industry that is growing and that will continue to grow in the future. But just understand the markets don't always go up, and then you can use the downturns as an opportunity to invest even more. Which now brings me to the second question you want to ask here, which is how you want to get paid. And there's two ways you can get paid. Remember, we just talked about this a couple minutes ago. You can get paid with appreciation or you can get paid with cash flow. Appreciation is when the markets go up and your stocks or investments go up. Cash flow is when you get paid just for owning the investments. You got to know what's right for you. For me, I personally am a cash flow investor. I love the idea of owning investments and getting paid without having to sell because now I can just work to stack the cash flow. Every week, I'm working to buy more funds that are paying me with more dividends, with more cash flow. That means every quarter, every 3 months, I get a bigger check. And then I use that check that I get to buy more of these cash flow producing funds. That way I can get even bigger checks. That's my goal. But the reason why this is so difficult is because practically speaking, it's going to take a long time before you get any significant amounts of dividends. I mean, if your fund is paying you 3% a year in dividends, you invest $1 million, you're only making $30,000 a year. Now I get it, $30,000 extra a year is a lot, but you need $1 million to do that, which is why a lot of people get turned away from this idea. But the way that you build wealth is not by investing $1 million today, because most people don't have $1 million to invest today. The way that you really build wealth is by investing a little bit of money today, a little bit of money next week, a little bit of money the week after that, a little bit of money the week after that, and after that, and after that, and after that. You do that month after month, year after year, decade after decade. And now what you can do is after 10 years of doing this, you can build a pretty significant stream of income if you stay consistent. But most people don't have the patience to wait 10 years to really see any big returns, because the reality is the first 3 years, they're pretty much negligible. I mean, it's pretty much nothing that you're going to get. But if you stay consistent, as you get a raise, as you make more money, you invest more money. As you get a bigger raise, you invest more money. And as you get paid from your dividends, you keep reinvesting them. By year 4, you start to make a little bit. By year 7, you make a little bit more. By year 10, now you start to make something significant. But if you're not willing to go through that, well, that's where a lot of people and a lot of financial planners will push people to the growth investments, which again is fine. I'm not saying it's a bad thing, but you just got to know what your goal is and make sure you're making investments that are right for you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.